Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone. I'm Kavita Baratake. A lot of you guys know me already. I founded a company called Cherry Street Investments. Before I started my own company, I was working in technology as a manager, an IT manager for about 20 years. I started as a software engineer and did all the programming stuff. And then I just decided I like investing better. I want to learn more about finances. So I started investing in real estate. I got full-time into real estate in 2019. And along the way, 2020 and COVID happened. And I thought, why not teach kids about money and managing money? So before that, when my daughter was in middle school, I have an 18-year-old. She's going to UT Austin. And when she was in middle school, I did this similar curriculum, but I did some after-school classes for financial education for middle school kids, just to teach them about all these topics, right? So that's where, during COVID, I started these sessions, and I wanted people to learn about, or kids specifically, 10 and up, to learn about finances. So this is a version 3, if you will, of the financial education. So I'm always open to ideas and better way of doing things. So if you have any feedback, please let me know. So today we want to talk about, this is the 5th session in the series. If you missed the other 4 sessions or any of the other 4 sessions, the recordings are all on YouTube. Today we're going to talk about taxes, why we pay taxes, what kinds of taxes, and a little bit more about taxes. So we're not going to just talk about, we have to pay taxes, but we're also going to talk about how we can reduce paying taxes, okay? And maybe you want to share that with your parents too. So my team is just me, and I have an executive assistant, Ritesh. So if you have any questions about getting into these webinars or otherwise not receiving any emails that you should be, or not getting the recordings, please reach out to Ritesh. It's ritesh.barke@gmail.com. Just a few housekeeping rules before we get started here. Please ask your questions in the Q&A box. I want you to find it, not the chat box. We will get to the questions at the end of the discussion. But as soon as you remember the question or it comes to your mind, please type it in the Q&A box so you don't forget, and so I can get to it when I'm done with my presentation. I just like to keep the continuity of the presentation and not break it up with a lot of Q&A, so it's easier to watch the recording as well. Recordings will be sent out within 48 hours to the email address of both the parents and the students. If you're missing a recording, please go to your spam and other folders and make sure you add my email to your whitelist so your emails are received. All recordings are also posted on youtube.com/@CherryStreet. That's my company. And I put a lot of information for both adults and children on this YouTube link. Please subscribe to my YouTube channel so you can be auto-notified of uploads and future videos as well. And you can support my channel too. So I appreciate that. So we'll look through the curriculum so far. We have covered 4 classes already: assets and liabilities, loans and insurance and bank accounts, and credit and debit cards. This is week 4 of the education, and today we're going to talk about income taxes, sales taxes, social security taxes, and much more. On Thursday this week, we'll have twice a week. So Thursday this week, we're going to talk about credit scores, how to understand what are credit scores, how to understand that, and how to build your credit score, more importantly. And then week 5 and week 6, we'll have other topics, and we'll end week 6 with investing 101. And again, if there's enough interest, I'll do one on college planning. That'll be week 7. That'll be the bonus webinar. Okay. So session 4 assignment was review with your parents what kind of bank accounts they have, what kind of debit cards they have, and how they use them. Do they use them on an everyday basis? Do they pay it off in full every month? Do they carry balances? What kind of cashbacks and rewards do they get with them? Investigate how they can add you to your credit card in a few years and give you a limit so you can have your own credit card and build your credit. So let's see, what are some of the lessons you learned? Anybody wants to share some of the lessons you learned from the week's assignment? Tell me about what did you find out? Like, what kind of credit cards do your parents have? Do they pay the balances in full, or do they do the minimum payments? Amaya says, be careful. Anybody? Anything about credit cards? Pay in full. Good job, Gianna. Always pay in full. They pay in full. So I said they pay in full and have multiple so they can build credit. That's right. My mom has debit cards for each of the properties she owns. That's great. So that means she also has bank accounts, right? Each of those bank accounts has credit cards. Don't lose your credit card. Okay, question. If you lose your credit card, what do you do? What do you do as soon as you lose your credit card? 2 things you need to do quickly. Anybody? Call the bank. Okay, you can do something else. Call the bank, report fraud. But there's something else you can do really quick without calling the bank. Anybody? You can go online and lock the credit card or cancel it, or report fraud online as well. So sometimes it might be easier, or you don't call 911. You definitely don't call 911 unless you're hurt, okay? You can call the credit card company. That'll be quick. But you can also go online and lock it. Sometimes you've just misplaced it somewhere. Let's say you put it in your house and forgotten where it is, right? You can lock it online. Lots of credit cards offer an option to lock your credit card. So that way, if you find it, you can unlock it. But if you truly lost it, it's probably better to call them and cancel it, or you can do it online too. You can report a cancellation, a report that you've lost it and cancel it online too. And sometimes it's just easier to go online than to call, because you're not waiting for a representative to get on the phone to go through the process. Also, it's better to call if you have any fraudulent use. If you log in online and start seeing transactions that you don't recognize, it's better to talk to someone and make sure that those are taken care of. Okay. Good job. All right. What else do they do? Do they have any cards for cash back? Do your parents have any cards for cash back? Are they getting any rewards? Chase cards. Okay. What kind of rewards are they getting? Like 1%, 2%, travel rewards? So you can use credit cards for those too. Bank of America travel rewards card. Yeah, that's right. Gift cards. Gift cards can be credit cards. You can have a Visa or MasterCard logo if you're giving a gift card to someone. Or you can get like a 2% cash back on your card. Southwest and American Airlines card, those are travel cards. So you collect travel points, right? So in Southwest or American, you can collect miles on those cards, and that will give you, you can use those points to fly towards basically flight tickets, which is very useful. Or you can even book hotel rooms with those points, okay? And Chase has the same thing. Chase has a point system called Ultimate Rewards. And then Ultimate Rewards can be used for flight tickets, can be used on Amazon to buy things. I use it on Amazon a lot, even though the conversion system is not the best. It's just very convenient. There's Delta mileage points. Good job. I think there's a lot of information here. So looks like folks have done their homework. The others who haven't, go back and do it again. There are some questions here. We'll get to that later. Okay, let's move on to today's lesson. We're going to talk about taxes, why we need to pay taxes, the different types of taxes, and much more. So Benjamin Franklin said, in this world, nothing is certain but death and taxes. When we're born, We have to die. If you make money, you're going to pay taxes. And that's the reality of it. Every country, every place we live in has some level of taxation. And every state you live in has some level of taxation. So it depends on where you live, about that contributes to how much in taxes you pay. So let's watch a quick video on taxation. I think that I really like this video. It's sometimes they say picture speaks 1,000 words, so we're going to look at this one. Okay, I'm going to stop share. I'm going to reshare 1 second. Share screen, share sound. I need to share the sound and then get back there. Otherwise, you won't be able to hear the sound.
Do you remember the very first job you ever had? Maybe it was bussing tables, bagging groceries, or working as a lifeguard. You put in your hours, keeping track of how much you expected to make, and when that first paycheck arrived, you opened it up and surprise! Some of that money had already been spent for you.
If you've ever looked closely at your pay stub, you probably noticed that Uncle Sam's portion is broken into two main categories: the Federal Insurance Contribution Act, aka FICA, and federal income tax. The first one is essentially a federal insurance program for the elderly and helps pay for retirement and medical programs for older Americans.
Income tax rates have varied wildly throughout history. Before 1913, they were actually forbidden by the US Constitution, thanks 16th Amendment.
As recently as 1981, the top tax rate was 70% for singles earning over $108,300. And the highest rate on record was in 1945 with a top rate of 94% for the ultra wealthy.
Now these days, tax rates aren't quite so high. But no matter how much the federal government takes from your paycheck, you should know what it's being spent on. Have you ever stopped to figure out exactly what is being bought with that money you send to Washington each year?
I think it's time to run the numbers. This is Tabitha. She works in HR and made $40,000 in 2017. After exemptions and deductions, her taxable income is $29,600, placing her in the 15% marginal tax bracket. Tabitha lives in a state with no state income tax, so at the end of the year, she ended up paying $7,038 in federal taxes.
Nearly half goes to Social Security and Medicare. These taxes, known as payroll taxes, are spent on health insurance and income for the disabled and people in retirement, like Tabitha's grandparents. Graham and Papa paid their FICA taxes when they were Tabitha's age, and now they're enjoying the benefits, just like Tabitha will someday.
That leaves $3,978 of Tabitha's federal income tax left to be spent. The largest chunk of your federal income tax goes to medical programs that help low-income families, like Medicaid and CHIP. That means that, including FICA, almost 60% of Tabitha's federal taxes are basically going towards insurance programs.
$930 of Tabitha's salary supports men and women enlisted in the armed forces, plus it pays for fighter jets, submarines, and Pentagon staff.
Tabitha may not realize it, but she's on the hook for America's loans. $525 of her income tax goes to pay back the debt the government borrows to stay afloat, plus interest.
$298 goes to unemployment and labor programs, $238 to veterans benefits like VA hospital and veteran job training programs, $179 goes to food and agriculture, and $167 of Tabitha's salary helps keep the government running, funding agencies like the FBI, Border Patrol, federal prisons, and even the salaries of her senators.
Tabitha spends $127 on transportation agencies like the FAA and TSA, and $111 on education, including Pell Grants and the National Endowment for the Arts. She gives $83 a year to housing and community programs, $63 a year to energy and the environment, $51 a year for international affairs like the State Department and Peace Corps, and $39 a year to fund America's science programs, which includes all federal scientific research and space exploration.
Although it might seem like those dollars just vanish from your paycheck, the money you pay the federal government affects real people and changes our world every day. It would be hard to find one of these expenses that doesn't touch your life or the life of someone you love.
And guess what? these numbers aren't set in stone. You can contact your local representative, national lobby groups, and educate yourself. The money our government collects in taxes doesn't belong to any one person or agency. It belongs to all of us collectively, and we should all get a say in how it's spent.
And that's our 2 cents.
We'd like to thank Audible for supporting PBS. Audible.
All right. So that was a short video on how or where our taxes go, right? And remember, these percentages are definitely not set in stone. That was just an example in 2017 of where things were going. And obviously the allocations change with time and the necessity. For example, the debt that US government has is in record trillions right now. So the amount of money we're spending in interest is much more than we did in 2017, right? So that keeps changing, but that was a gist of understanding where taxes are going. When you pay taxes, the government just doesn't take it away. They allocate it in different buckets for different programs that they support, right? So where do the taxes go? They pay the salaries of all the government workers. They are the primary contributor to national defense that supports our military, supports common resources such as police and firefighters, ensures that the roads you travel on are safe. And for example, in Texas, we have an organization called TxDOT that maintains all the transportation, like the roads in Texas. So they make sure that they are safe and well maintained, and they pour tar over them, and they take care of them. So you are safe on the road, right? It funds public libraries and parks. It supports social and security income to the retired. It covers Medicare and Medicaid insurance programs, which are for elderly people as well as people who are not able to afford insurance, and also covers welfare programs like food stamps. So people who are not able to afford food can buy food, right? So what kind of taxes are levied? They're federal income tax, social security tax, Medicare tax, excise taxes, capital gains tax, estate tax, gift tax, a lot of different taxes, right? Those are at the federal level. But in addition to federal taxes, which is, at the nationwide level, we also have state taxes. We have state income tax, sales tax, franchise tax. We have municipal and local taxes. Let's say you live in a county. The county might assess a property tax, right? Which you pay on the house that you own. They might have hotel taxes. So if you go to a hotel, stay in a hotel room for the night and look at the bill at the end of the night, they'll include taxes. So those are your hotel taxes. And part of the state sales taxes from the state also comes to the municipal and local authorities. Income taxes. Let's talk a little bit about federal and state income tax. So the federal income taxes is not a flat tax. So let's say you make $100,000, the government just doesn't take away 22% of 100,000, right? It's not a flat. Like let's say you're in the 22% bracket, they still don't take away 22%. It is a tiered structure that depends on how much you make. So if you're making 100,000, they take away, let's say up to 11,000, you'll pay 10%. From 11 to something else, you'll pay a little bit more. And from 12 to 44,000 to 100,000, you'll pay something else. So it's a tiered structure, and we'll look at the tiers shortly here. The deductions allow you to pay less taxes. So what are deductions? So let's say you have a child. You get to get a deduction as a person with a child, because obviously you have to take care of your child. For yourself, you get something called a standard deduction. So the standard deduction was $12,200 a few years ago. It's a little bit higher now, but that varies every year. All they're saying is you get to deduct a certain portion before you pay the taxes. So if you're making 100,000, you get to remove the 12,000 first before you get what's called an adjusted income or adjusted gross income, and then you pay taxes on that. We'll go through that in a second. In state income taxes, for those of you who live in California or Oregon or Hawaii, for example, you pay state income taxes in addition to federal income tax. I live in Texas, and we don't pay state taxes here. So rates are 0% in Texas, Florida, Tennessee, for example. California is really high. California, Hawaii, or Oregon, and Minnesota are up to 13.3%. Again, it's a tiered structure. The highest bracket will be based on your income, right? So the more money you make, the more you pay in taxes, generally, unless you know how to pay less taxes. So let's look at the tiered income tax structure. For example, let's say you decide you are 16 years old, you decide to go get a job, and it gives you, let's say, $10,000 a year, right? A part-time job somewhere. You're working at Chick-fil-A. Up to $10,000, since you are single, right? You're not married, you're hopefully not married at 15 or 16. So you're making 10,000, so you're going to pay 10% of 10,000. So that's usually the case, although there are some exclusions to that. But generally, you'll be paying 10% of 10,000, which is $1,000 in taxes. Again, if you are making $15,000, you'd pay 10% on the first 11,000, and then you'll pay 12% on the remaining $4,000. Does that make sense? It's 15 minus 11 is 4. So you'll pay 12% on the 4,000. So that's how the tiered structure works. So the highest tax bracket is $37,000. And then the single filers, married people filing together, and then it's called head of household. Sorry. The head of household is usually when you have a child and you are maintaining a household of one or more children, right? Otherwise, you don't get the head of household. So you can see when you have a child, let's say you're single, no children, or you have single and you have a child, you get a different deduction, basically to account for the fact that you're taking care of another person, another child, another dependent, more importantly. So the highest tax bracket is 37. The lowest can be 10 or even less if you have more deductions. So let's say you made $10,000, but you have some deductions. You actually won't pay any taxes actually on 10,000 because you have a standard deduction of 12,000 plus. You're not going to pay any taxes up to that, really. So let's talk about this. So there's the adjusted part. Let's say I was actually making $87,000, right? Actually, my income is 87. I'm single. Let's say my standard deduction, which is the deduction I claim for myself, was 12,000, just to keep the numbers easy. Now, 87 minus 12 is 75. That's my adjusted gross income, okay? So what you get taxed on is not your gross income, it's your adjusted gross income, and the adjustment is after removing your deductions. In this case, let's say I don't have any children, I'm single, and I made 87,000, and my just for calculation purposes, my standard deduction is 12,000. I believe the standard deduction is 15,000 or something around right now. I'm not sure of the exact number. Anyway, so let's say I have an adjusted gross income of 75,000. Here's what happens with my taxes. 0 to 11,000, I get taxed at 10%. 11 to 44,725, I get taxed at 12%. And then 44 to 75, I get taxed at 22%. So my tax is really an accumulation of all this. So it might be somewhere around, let's say, I don't know, 15 average of, you have to see the average, right? You have to calculate the averages. So that's how the tiered tax system works. So the video talked about something called FICA taxes, federal insurance taxes. So they are also called payroll taxes. So there are two payroll taxes that go in. One goes to Social Security and Social Security tax. And that's a combination of what you pay and what your employer pays. Employer pays a certain portion, you pay a certain portion. Then Medicare goes to support the Medicare programs, and that's 1.45% each from your employer and employee. If you are self-employed, guess what? You pay twice. You pay the employer side and the employee side. So you actually pay 12.4%. And then here you pay two times of this, which is 2.9%, right? Yeah, 2.9%. So If you're over a certain amount, over a certain wages, then you pay an additional 0.9% in tax. So the FICA taxes are, again, take away almost between 6.2 and 2.9. So that's 8.1% or so. And this is of course only one side. If you are working for someone, then your employer is paying the other portion. But if you're self-employed, let's say you're a realtor, then you pay both of these. So you pay 15 or 12.4 plus 2.9, which was almost 15%, right? So it's a lot of taxes. Then we have something called property taxes based on, so the property tax is obviously assessed for a property. It can be a house that you're living in. It can be a rental house that you own. It can be a piece of land that you own. It can be a car wash. Let's say I own a car wash. It can be that. It can be any kind of property, right? Real property. So it is based, this property tax that the county assesses is based on the tax assessment value. What does that mean? That means that, let's say my house was worth, let's say $400,000 5 years ago. Now the assessor says that no, my house will sell for $700,000 right now. They're going to assess a value called a tax assessment value. It could be equal to, lower than, or higher than the market value of the property, which means, let's say it's going to sell for 700. It could be less than 700. Could be more than 700 or equal to 700. So the kind of assessment depends on the state that you live in a lot. In Texas, assessments are done every year. In California, assessment is done when you buy the house, and it doesn't go up that much over the lifetime of the property. In Texas, it goes up every year. So every state and every county is a little bit different on how they assess. So there's not like 100% exact rule to follow, and you have to kind of see how the county assesses the taxes. So it is paid as a percentage per $100,000 of assessed value. What does that mean? Let's say we actually have an example in the next page, and we'll talk about that. So every $1,000 of assessed value, you pay a percentage in property taxes. It's also called, you'll see the word ad valorem, which is the Latin word for based on value. Okay, meaning that you're paying taxes based on its value. Ad valorem. Example. I own a house, and the appraiser determines that my value of the house is $600,000 for 2023. I go back and forth. They assess it at, let's say, 650. I go back and forth, and I disagree with them, and I protest it. Then they bring it down to 600,000. Now, the property tax rate where I live is 3%. Okay, and so the yearly property tax payment is 3% of $600,000. So if you compute this, the number is $18,000. Okay, so that's what I pay every year for a house worth $600,000 with a property tax rate of 3%. Now the tax rate varies depending on where you're living. In Austin, it can vary from 2.2 all the way to 3.3, 3.5 even. So it depends on which county you live in. So one of the questions in the list might be, go back and look at your property tax statement with your parents, and I want you to review the property tax statements and see what kind of property tax rates you're paying, right? And how much are you paying a year in property taxes on a house that you own? Let's talk about state taxes. State taxes are charged on all retail sales, leases, and rentals of most goods, as well as taxable services. So if you go buy a car tomorrow, you're going to pay sales tax on the car. If you buy any packaged food in H-E-B or any other grocery store, we have one called H-E-B in Texas, you're going to pay taxes. The exceptions to sales taxes are unprepared food like vegetables, and medicines. Those are the only exceptions that you don't pay sales taxes on. So the sales tax percentage depends on the state where you live, as well as the local taxing authority that you're a part of. So let's talk about how it is. In Texas imposes a 6.25% state sales and use tax. Local taxing jurisdictions, remember there are cities, counties, districts, transit authorities, they all get a portion of this. Your counties are getting something, your transit, like let's say you have BART in California, now BART gets a certain portion of that. So the 2% tax is going towards, in Texas especially, is going towards all these combined local jurisdictions, taxing jurisdictions, for a total of 6.25 plus 2%, which is 8.25% in most places in Texas. And again, it might be different in California. So we're going to, or California or North Carolina or New York or wherever you live, right? So let's talk about excise taxes. Excise taxes differ from sales taxes in two fundamental ways. First, it's only on specific goods. So sales taxes are assessed on almost all goods except uncooked foods, like unpackaged foods, as well as medicines, right? Here, it's only on specific goods, whereas sales tax applies to just about everything you buy, except those two exceptions. Second, it's a flat tax applied before the purchase of specific items, some of them by states and some by the federal government. Example, luxury goods or those that have been linked to specific health issues like cigarettes, alcohols, tanning salons, etc. They have excise taxes. Okay, they're also called sin tax. It's called sin tax, the alcohol cigarettes tax. Capital gains tax, and I think there was a question in the chat box about this. We'll go through that. The capital gains tax is a government fee that on the profit made from selling certain types of assets. So let's say I sell some stocks that I bought and I made some money, or I sold a house this year, I'm making some money. I have to pay capital gains taxes. The capital gains tax is calculated as the total sale price minus the original cost of an asset. So if I bought a house for $100,000, and let's say I put another $20,000 fixing up the house, my original cost is $120,000. And let's say I sold it for $250,000. So my total capital gain that is going to be paid is on a total sum of 250 minus 120, right? Which is $130,000, if that makes sense. So let's talk about short-term versus long-term capital gains. So if you have owned the asset for less than a year, then it's called short-term capital gains. If you owned an asset for more than 12 months, then it's called a long-term capital gains. So usually short-term capital gains is charged at your income tax bracket. Let's say you're at a tax bracket of 37% and you make a lot of money and you sell a stock that you owned for 9 months and you make a huge amount of money. You're going to pay 37% in taxes, and that's called a short-term capital gains tax, okay? On the flip side, the long term, let's say I bought a house in 2017 for $130,000. I recently sold it, let's say for $280,000. And so net, I made about, let's say, $150,000. So I'm going to pay between 15 and 20%, depending on my tax bracket. That's the range. In a long-term capital gain. The reason it's long-term is because I bought it in 2017 and I sold it in 2023. So that's 6 years, right? So it's longer than 1 year. It's going to be long-term, okay? And so you can see that you'll save money by holding an asset longer, and you'll pay more taxes if you have short-term gains. We also have something called estate taxes. In the US, IRS has applied this year, it has applied a limit of $12.92 million for 2023, over which estate taxes are applied. If I die, let's say I have an estate worth over $12.9 million for this year, and if I'm leaving it to my heirs, then there'll be estate taxes applied, and estate taxes are pretty large usually. And so let's hope we all make enough money to pay, to be not wanting to pay, but to be eligible to pay estate taxes, but we'll figure out how not to pay it, right? We'll reduce the taxes. So normally, if you have a limit below this, there's no estate taxes applied for transferring. to your heirs, right? Like when you pass away. So just to recap, we talked about income taxes, social security tax, Medicare tax, property taxes, capital gains tax, both short and long-term capital gains, sales tax, estate taxes. Are these all the types of taxes there are? Absolutely not. We just covered like a little sliver of all the taxes there are, but this is probably, I'd say that the first 6 are probably the most important taxes that you'll be exposed to pretty quickly when you start working. So the big question is, can you pay less taxes? So in the first class we did, if you watched it or you attended the first session, we talked about this EBSI. Anybody remember? So what we're doing here is, if you have an active income where you have a job, right? You're an employee, you are actually paying the most for your most amount of taxes. Okay, so you have a job. What this means is you're trading your time for money, right? You're trading your time, you're putting in your time, and somebody pays you money. So let's see what happens here. You pay income taxes, you pay 50% of the payroll taxes, meaning that the employee pays the other 50%. And you have very little, or if any, basic or low deductions. You might have a standard deduction. You might have a deduction because you're head of household and you have kids. You might have dependent deduction because you have children. There are also some childcare tax credits, but it's very basic, very low options for actually saving on taxes. Let's say you go to the self-employment side. Remember, I told you when you're self-employed, you're paying both the employer and the employee portion of the FICA taxes. FICA is payroll. Okay, so we use FICA payroll kind of interchangeably. The payroll includes FICA and Medicare. So you pay income taxes, you pay 100% of the payroll taxes, but you do get few deductions for business expenses. So let's say I can expense my home office. If I work from an office building, from a room in my house, I can expense the home office. I can expense my travel and gas miles to, if it's used for business purposes. I can expense the miles on my car and say, okay, there's maintenance on my car because I'm running these miles. So there's a lot more expenses that you can get from being self-employed, although on the flip side, you pay a lot in payroll taxes. Okay, so remember, on this side is where you, I'm going to go back here. This is your side. The left side of this quadrant, of the 4 quadrant, is where you pay a lot of taxes. Okay, the left, employee and self-employed side. The right side, you still get to pay 50% payroll taxes, but you own a business here. Okay, so just to go back here, this is a business owner. You own a system and people work for you. It's not dependent on your presence. So let's say I'm a dentist, and if I don't come into the office, I don't make any money, right? It's my own office. I own the practice, but if I don't come in, I don't make any money. That's not passive income, right? You are making active income, because then you're self-employed, because if you don't come in, you don't make any money. But let's say I have a dental practice, and then I have a couple of dentists who work for me, right? People work for me. I don't go into office very often, but I pay a salary to these dentists, okay? They come work there, and I own the dentist office. Then I own a business. I'm a business owner. People are working for me. Even if I don't come, the business still makes money. So that's called passive income. Passive means I'm not trading time for money, okay? And you use people to make dollars, and you leverage people, other people, not yourself. So what happens here, you get income tax. You do pay income taxes, you do pay some FICA and Medicare taxes, but you get a lot of deductions. A lot more deductions are available when you go to become a business owner. Finally, we'll talk about where you can make a lot of money is being an investor. If you're an investor, you pay capital gains tax, which is also a lot of ways to offset the capital gains tax. Okay, when you're an investor and you know what you're doing, you can offset those capital gain taxes, which means you don't have to pay them necessarily. You can push it forward or defer it. So let's say I owe taxes this year, but I'm able to not pay it till 5 more years by doing certain strategies. That's called a deferral. Okay, you push it forward. And this gives you a lot of deductions. And also important is that this here, your money is working for you and you're not working for your money anymore. Similar to this, but this is a one up from here. You're just investing your money to make more money. Here, you're investing into people, you're paying people to make money. Here, you're putting money to make more money, if that makes sense. Okay. Let's move on. So this is your high tax side, these two, employee and self-employed. If you want to pay less taxes, you're on this side, which is business owner or investor. So every one of you can be an employee and can also be an investor. Okay, it's not exclusive, but eventually you want to learn how you can become an investor so you don't have to be an employee anymore and work for someone. Right. So here's the assignment for this week. What kind of tax bracket do they fall into? I want you to go back and sit down with your parents and figure out how much money they make. Again, you're not sharing it with me. This is just to learn. What kind of income tax bracket do they fall into? I want you to ask them for their paycheck copy and review it with them. What kind of deductions do you see? Do you see federal income tax? Do you see state income tax? Do you see Social Security or FICA? Do you see Medicare? If they're a business owner, talk to them about what kind of taxes they pay. Ask them questions about taxes. Learn what kind of taxes they pay. Do they pay property taxes? Do they own rental properties maybe? What kind of property taxes do they pay on their rental properties? If they own a car wash or if they own a business, they may own a building. What kind of property taxes do they pay on the building? Can you ask them for a copy of the property tax statement for me? Okay. Also determine what portion of their money effectively is given away in combined taxes. And also, I want you to talk to them about the EBSI we talked about, the quadrant, and ask them if they're doing anything to reduce the taxes that they pay. Are they contributing to their 401k? Are they investing their money in some investments to reduce their taxes? So these are all questions I want you to go back and discuss with your parents for this week. All right, let's get to the Q&A right now. Any questions? So Ishleen commented that our debt is 31.4 trillion US debt, and that's what we all are paying towards right now. Thank you, Ishleen, for that information. All right. Sai asks, do you have to pay capital gains tax on bonds, even if it's your government you're giving loan to? Yeah, it kind of seems kind of odd, right? So there are some municipal bonds that are, you don't have to pay capital taxes on, Sai, but generally, yes, you still pay capital taxes, gains tax on bonds if you sell them within a certain amount of time. Right? Which state has the highest taxes? Gianna asks. Gianna, as far as I know, it's California, Hawaii. All of them have about 13.3%, I believe. Gianna asks, if you're married and have kids, how do you know who's the head of the household? It doesn't really matter. One of you might file as a head of household, but you remember, if you're married and you're usually filing together with your spouse. So you'll just get married filing jointly, and you do get deductions, higher standard deduction, dependent deduction, and all that good stuff. So head of household is only if you're single and have children, usually. Why are unprepared foods and medicines exceptions to the sales tax? I don't really have an answer to that question. That's a really good question. And I want you guys to add that to the list of things you should research. I would assume that giving us a break on some little thing, something that's not packaged and prepared, that's just a raw material. And medicines, again, we are paying taxes in different ways for the medical system here. We're paying health insurance and all of that stuff. So probably some way to ease taxes somewhere, I don't know. That's a good question. When to get a credit card? How to get an early credit card? We'll talk about that in next week's meeting. When on credit history, and not next week on Thursday, we'll talk about credit history, how to build it, how to open a credit card, and blah, 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 all of that stuff. Any other questions from today's session? If someone becomes a widow, does the tax category become single section? It actually becomes single or household, depending on whether they have children. So if, let's say, a widow has kids, then she becomes the head of household. Otherwise, she would be single tax status. That's correct. Good question, Ishleen. Any other questions? Going once. We have a quiz now, so I hope you guys are ready. There'll be some prizes on with Amazon gift cards. Based on the count today, I'm going to give away, let's see. I always look at how many kids have joined in. So we'll do 3 gift cards today, okay? $10 each. So the top 3 kids get gift cards to Amazon. So you can email me after the session and let me know your email to send the gift card to. The link will be shared for the quiz shortly. Before that, I have a short poll. I kind of want to understand what I could do better. So if you can please answer the poll really quick for me, we'll spend a minute here. Let's keep it really quick. And I want some feedback on, are you finding the Moneywise Learning sessions useful? Is there something I could do better? Even if you're finding it useful, I'd love to hear if you have any feedback or suggestions for improvement, and you can send it to my email over there, kavita@cherrystreetinvestments.com. Would love your feedback. All right. All right. Thank you, guys. 100% people found this useful. I appreciate your feedback. And also, please email me. And, if you have any other feedback that I could make this session better for you guys, I'd love to hear it. Thank you. So here's the suggestions today. So 100% of the people found this session useful. Thank you. All right. And also, if you have any suggestions, please join this FB group. It's called Moneywise Learning. At facebook.com/group/Moneywise Learning. Your parents can join us if you can't. The next session will be Thursday at 4 p.m. Central again. Credit scores. We'll talk about understanding credit scores and what goes into credit scores and how you can build your own credit score. Okay. It doesn't matter how old you are, you can still start building your credit score. So Nisha and Neil Gade, please email me. Thank you, guys. That's it for today. Thank you so much for joining. And we will talk again on Thursday at 4 p.m. Central about credit scores. Don't miss the class. And also don't forget to do your homework. Thank you. Bye. Hi, I'm Kavita Bartake. I hope you found this video useful. And if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.